session at some point. If these issues can get resolved, we will turn on the video. The screen is on. I don't know why screen is not visible to you. It should be visible to you. But all right, so let's start with discussing the paper format a little bit, and then we are going to go on further, and we are going to start discussing the actual syllabus. So here is this how this is going to go on. I will be covering my slides. Within these slides, I have mentioned a few practice questions that we are going to be doing. These practice questions, in my opinion, are enough for you to actually prepare for your P1 exam. I will start with the paper format. Your paper is going to be for 100 marks. I'm sure you know that. It is going to be 3 hours and 15 minutes long. You're going to have a 50-mark case study in the beginning and 225-mark questions that you will have to attempt. You will actually be given 325-mark questions. You will have to choose one of them, so you have a choice in your professional exams. Now, how are you going to be attempting this exam, or what are the techniques of actually attempting the exam? As we go forward, as we go through the syllabus, please be aware that I will be telling you the technique of actually attempting this exam as we go through the questions and as we go through the syllabus. So if you're expecting me to go through them at the end, I will go through them at the end as well when I discuss the mock with you. But my priority or my thinking is that I will specify the technique of attempting the P1 exam as and when we actually do questions. Now, the first trick to passing the P1 exam is actually finishing the exam on time. A lot of students in professional exams are unable to finish 100 marks in their exam and actually end up failing the exam simply because they cannot finish the exam. So your first motive when sitting for the exam should be to actually finish the exam on time and attempt all 100 marks in the exam. How are you going to do that? By reducing the time that you take in writing down the answer and increasing the reading time during the exam. So while normally teachers say that you should spend 1.8 minutes per mark attempting the question, I say you should spend 1.5 minutes per mark attempting the question. Now, what you should do is, while attempting those questions, take 1.5 minutes per mark, and the time that you are saving by writing in lesser time, you should spend in actually trying to read the case study and make sense of it, because that is more important than actually attempting the case study as well. So I have a couple of reasons that I wanted to discuss with you for failures, but since I can see that most of you cannot see the screen and can only hear me, I'm going to give a 5-minute break. I'm going to resume in 5 minutes till we sort this out. I know that you can't see my screen, which is why I'm giving a 5-minute break. We're going to come back, and you can probably then, you can see me and you can see the screen as well. All right? All right, guys. Tell me if you can hear me and see the screen. The screen should be P1 lecture notes, Pasmanur, and everything. No sound. That was because I wasn't speaking. Yeah, you should be able to see me now. Oh, sorry, hear me now, because now I'm speaking, and you should be able to see my screen as well. Yeah. Yeah, screen and voice both are perfectly working. Yeah, perfect. All right. Watching a P1 screen. Yep, that's the screen we have. Yep. All fine. Okay, that's perfect. Okay, so before I actually start the session, please bear in mind that I cannot have a one-sided session at all. I will need you all to actually participate in the session. I will be asking lots and lots of questions to keep you guys on your toes and to know that you're actually listening and that you're understanding. So I am going to be asking lots of questions. I want your complete attention. I want your hands on your chat boxes. I want your answers in time so that we can have a great interactive session. All right. So I was discussing the P1 exam and the exam techniques with you. And what we actually did was that the exam is going to be in 2 sections. And the first section is going to be 50 mark case study. And the second section is going to be 2 questions of 25 marks each. All right. So within those these 3 questions, the 50 mark case study and the 2 25 mark questions, the P1 examiner is most probably, and mostly actually, covers all of your syllabus. So the first thing that you have to remember is you cannot be selective in the topics that you are studying. Which brings me to one of the most important points in this session, and that is that we are not going to be covering the entire syllabus within these sessions. We are going to be covering all key topics. So all of the key topics that you should know and which will be covered by the exam, we will be doing. There will be some miscellaneous small topics that we will not be covering, that will be left out, but that's entirely because I will be forwarding a set of revision notes to you by the end of this session, and we are going to be ensuring that whatever I don't cover within these sessions, I'm going to be covering through those revision notes. So you have to understand that if you're looking for all miscellaneous small topics within this session, you're probably not going to find them. We're going to be covering key topics throughout the session, and I'm going to be forwarding a set of revision notes by the end for you to go through and for you to prepare the P1 text from. All right. So let's go through some of the key reasons why students fail the P1 exam, or the reasons for an unsuccessful attempt. Those are that most of the students leave an incomplete paper. Now that's primarily only because students spend a lot of time thinking and attempting the question paper, and what they should be doing is taking more time thinking and reading the question paper, and then taking lesser time to actually attempt the exam. Because if your answers are well thought out, you do not need more than 1.5 minutes per mark to actually attempt the paper. The second most important reason why students fail the exam is lack of application of knowledge to information in the question. Now, while a lot of students actually know the concepts of P1, they have no idea how to actually apply those concepts onto the case scenario that's sent, which leads to an ultimate failure. Now, what we are going to be doing during these sessions is we are going to be practicing questions, and within those questions, I am going to make sure that I discuss the requirement at length. I discuss what is required of the students by the examiner within each question. I am going to break down every requirement for you, and we are going to discuss how much to write and exactly what to write in all of the requirements that we cover. The last reason for a failure is misunderstanding the requirement verb. Now, what is a requirement verb? I'm just going to escapist, and use a pen. Over here, what is the requirement verb? The requirement verb is normally the first word of any requirement. Now, what normally happens is, since students are in that exam mode, they fail to look at what the requirement actually is, how many parts there are in a requirement, and they fail to actually understand what the examiner wants in a particular requirement. Let's go through some of the requirement verbs that the examiner often asks of the P1 students. Now, the first requirement verb is assess. Now, in assessment, please remember that the examiner is asking for a candidate's opinion and arguments in favor of the opinion given. Now, this is very important to understand. When the verb assess, when you see the verb assess in the requirement, what you have to do is you have to give the examiner your conclusion on a specific topic, and then you have to support your conclusion with arguments that you have chosen from the case given. Now, this is very important. So, in case, for example, your requirement says assess the company's performance. This means that the first line of your answer should be whether you think that the company's performance is up to the mark or not. And if you've said that the company's performance is up to the mark, you have to justify your answer using reasons from the case scenario given. If in case you have given your assessment as the company's performance is not up to the mark, then you would have to pick the reasons from the case and give them in your answer so that you can justify the assessment that you have given. In assessment, your opinion is required by the P1 examiner, and the P1 examiner will be looking for justifications of your opinion from the case. Now, the next verb is evaluate. When the P1 examiner asks about evaluation or asks the students to evaluate, what he wants from the students is a balanced view of the positives and the negatives both. So in evaluation, students will discuss the advantages and disadvantages of topic tested. And this is very important. So for example, if the examiner has asked you to evaluate the remuneration package of a director, then he's asking you to discuss the advantages of the remuneration package and the disadvantages of the remuneration package both. Remember, in evaluation, you must, and this is very important, you must give a balanced view in your answer. When the verb evaluate comes in your exam, please discuss advantages and disadvantages both of a certain topic and not just one perspective. When the verb critically evaluate comes, you have to discuss positives and negatives both. So essentially, is there a difference between evaluate and critically evaluate? No. They are both synonymous in the exam. They are both synonymous. They're both used interchangeably. In both cases, evaluate or critically evaluate, you must discuss the positives and negative aspects both of a certain topic. When the verb criticize comes in the exam, the examiner is only looking for a certain topic's disadvantages. Please remember that there is a difference between critically evaluate and criticize. In critically evaluate, the examiner is asking for both. In criticize, the examiner is asking only for negatives of a concept. So if the examiner has asked you to criticize the remuneration package of an executive director, remember, you will only discuss the negative aspects of the remuneration package in the exam. When the examiner is asked to construct a case for, so he will often ask you to construct a case for. He's asking you to discuss advantages of a topic only, just the advantages. So remember, for example, the examiner might ask you to construct the case for an audit committee for ABC company. What the examiner is asking you to do is write down the advantages of the audit committee to the company in your exam. Similarly, if the examiner has asked you to construct the case against, he is only asking you for the negatives of a certain topic. So if the examiner has asked you to construct a case against having a lot of non-executive directors on the board of directors, then he is only asking you to discuss the disadvantages of having too many non-executive directors on the board of directors. Please remember that these requirement verbs are not exhaustive. So this is not an exhaustive list. You may get other requirement verbs as well. However, these are most often used by the P1 examiner. In assessment, you have to give your conclusion and then justify your conclusion using reasons from the case. In evaluation and critical evaluation, both. So both are synonymous, both are used interchangeably. You have to discuss the advantages and disadvantages both. So you have to give a balanced view of the answer. If the examiner is asking you to criticize only, that means the examiner is only asking you for the negative aspects of something. If the examiner is asking you to construct the case for, then just discuss the advantages. If the examiner is asking you to construct the case against, then just discuss the disadvantages, and that's about it. So these are the most often used requirement verbs by the examiner. Assess sanction would mean that the examiner is asking you for your opinion. Please excuse my handwriting. It is only going to get worse throughout the sessions. So the examiner is asking you for your opinion regarding a certain matter. So if the examiner has asked you to assess the company's performance, then you would have to give a conclusion on whether you think the company's performance is up to the mark or not, and you have to give reasons why. Now, I'm very quickly going to go to understanding for-profit organizations, the agency costs, and everything. Since I'm very attuned to actually writing on the board, I'm going to be opening a normal Word document, an empty Word document, and I'm going to be doing a lot of scribbling on this Word document so that we have a board that I can work with. All right, so I am going to be referring to the slides from time to time, but I am going to be scribbling a lot on these Word documents. So if you have any confusions, you can ask me. We are going to be covering slides 6, 7, 8, and 9 right now. All right, so we're just going to get started on the syllabus. What I'm right now going to do is mention that the P1 examiner gives you the example of three kinds of companies in your exam. The three kinds are a public company, a public sector company, public sector company, and a not-for-profit organization. Now, these are very important for you to know, and you should know the differences between these three types of companies. So normally the P1 examiner is going to be assessing three kinds of companies in the exam: a public company, a public sector company, and a not-for-profit organization. You should know, a P1 student should know the difference between the three kinds of companies. We are just going to be covering these differences. A public company is normally also called a listed company. It is called a listed company because shares of listed companies are listed, registered, floated, or quoted on a stock exchange, which is why normal general public can buy and sell shares of this company. This is the reason why listed companies are normally called public companies. These are normally profit-making organizations of which shares are floated on the stock exchange for normal general public to buy. A public sector company is normally a company that is owned or controlled by the state. So it is normally owned or controlled by the government or by the state. This is called a public sector company. They normally do not work for profit. They do work for public welfare. Since it is run by the government, it is going to be working for public welfare. A not-for-profit organization is an organization that is, all right, public welfare. A not-for-profit organization is an organization that is only working to reallocate resources among individuals. So we're just going to be covering details of all three kinds of organizations. The first thing that we are going to be covering is the difference in the agency relationship of the three kinds of organization. So when we're talking about the agency relationship, we're talking about two kinds of parties: principals and agents. So there is an agency relationship that is present in a public company, a public sector company, and a not-for-profit organization. Why should a P1 student know about this agency relationship? Because this is tested in the exam. Sometimes you're going to be given a case study that is based on a public company. Other times you're going to be given a case study that is entirely based on a public sector company. Other times you are going to get a case study that is based on an NFPO, a not-for-profit organization. In order to attempt questions of all three kinds of organizations, you should know the basic difference between the three. So I'm just going to erase this because I need some space. All right. So when you're talking about the agency relationship, what is the difference between a public company, a public sector company, and an NFPO? In a public company, remember, the principals are shareholders. Why? Because they are the fund providers. So how does a P1 student know which entity is the principal and which is the agent in a relationship? Remember, the normal concept to memorize is any party that is the fund provider in an organization is going to be the principal in that relationship. So any party that is a primary fund provider is the principal in the relationship. So in the case of a public company, principals are the shareholders since they provide funds by buying shares of a company. Within this relationship, The agents are the directors who have been hired by shareholders to run the company on their behalf. Now, this is very important. The agents normally are stewards of the principals, and in a public company, directors are the stewards or directors are the agents. Why? Because they've been hired by shareholders. I'm just writing SH, this is short for shareholders, hired by shareholders to run the company on their behalf. All right. Similarly, when you're talking about a public sector company, can anyone tell me within this chat box, everyone, now is the time that you have to participate and let me know that you're listening. Can anyone tell me who are the fund providers or the principals in a public sector company? Can anyone tell me within the chat boxes, please, who are the primary fund providers or the principals in a public sector company? Who provides funds to a public sector company? The public, the government, shareholder. I love that you're all answering. I love that I have a mixed batch of answers. Always remember. All right, that's perfect. In the public sector, remember the government is not the fund provider in a public sector company. A public sector company is run by funds provided by taxpayers to the government. Remember, in a public sector company, the principals will always be the taxpayers. Remember that I could have written public over here, but that would have been the wrong answer. Why? Because we all know, do all individuals in the public pay taxes? The answer is no. Some individuals pay taxes, others only receive the benefits from those taxes. So remember, public is not the right answer. Government is not the right answer. In a public sector organization, the fund providers are the taxpayers who provide funds to these public sector companies so that welfare of people can be delivered. So, all right. How to answer the answer. All right, I'm listening. I'm looking at your questions. You can't see me because the video is not working for some reason, but I am looking at your questions. We are going to be attending to all of the questions, but you have to understand that answering questions within the session and then actually finishing the session on time is a huge task. There are 126 of you right now. So you have to bear with me until I actually finish a topic and get to your questions. I will get to your questions. I promise you that. I will be giving you my email address as well by the end so that if there are any queries, you can forward them to me at the end of sessions. And I don't mean at the end of the day, at the end of sessions, so on Saturday. All right? So, in a public sector company, the taxpayers are the principals. Why? Because they are the primary fund providers in a public sector company. In this very public sector company, the agents are the people who have been hired by taxpayers to actually run the public sector company. This would be government officials, elected government officials in a public sector company. Similarly, in a not-for-profit organization, can anyone tell me that in a not-for-profit organization, who are the primary parties that provide funds to not-for-profit organizations? Please don't say general public, because all individuals in general public are not fund providers for an NFPO. Listen to my requirement carefully. Please answer. Who are the fund providers in a not-for-profit organization? The correct answer is what most of you are saying, the charity providers or the donors. Well done. So in a public sector company, the donors are the principals or are the fund providers. Similarly, in a not-for-profit organization, who actually uses these funds to fulfill the purpose of the charity or of the not-for-profit organization? These are the trustees. You must remember these concepts, that principal-agent relationship in different kinds of organizations is different. Now let's come to another issue within these types of companies. Let's look at the conflict in agency relationship in different kinds of companies. And let me tell you that the conflict is not the same. In a public company where shareholders are the principals and directors are the agents running the company, the conflict is that shareholders want high returns and directors want high remuneration, so high salary. Now listen to this carefully. The conflict is that one company can only fulfill one party's objective at one time. One party will have to be compromised upon and one party's objective can be fulfilled. Remember this. Please understand that in 1 year, a company can either earn a higher profit or give directors a higher remuneration, which will in turn reduce profits. So can we keep directors and shareholders both happy at the same time? The answer is no. Why? Because this conflict exists. Why? Because principals and agents are different and both have different objectives. Shareholders want maximum returns in the form of dividends, in the form of profit, in the form of capital appreciation. Directors want a higher remuneration, and if in case the company chooses to pay directors highly in 1 year, it will earn lesser profit, which means lesser dividends to shareholders. So that's the conflict in a public company. In a public sector company, the conflict is that normally the taxpayers are not service users. So in many countries and in many public sector organizations, the problem is those people who benefit from public sector organizations are not normally those people who are paying taxes. So I pay taxes, but if I don't go to a government hospital and if I don't go to a government school, then mostly I'm not utilizing my own paid money into public sector organizations. That's the first conflict. The second conflict is there is a high number of taxpayers and every taxpayer has different priorities. So, as a taxpayer, I might want my money to be utilized primarily in health funding. But another taxpayer might want his or her funds to be used in education or in infrastructure. What that creates is a conflict. So we are just talking about different kinds of conflicts that arise because principals and agents are different. So as a taxpayer, I might want my tax money to be utilized in health. However, the government officials that actually run public sector organizations will have different objectives. They will follow the objectives based on which they won the election. So maybe the government officials want to fulfill the defense criteria first or the infrastructure criteria first, in which case I have a conflict with the government officials. Why? Because I want my tax money to be used in health, while the government officials believe that infrastructure or defense should be their first priority. That is the conflict in a public sector organization. Remember, P1 says in whichever entity that you're talking about, be it public company, public sector company, or a not-for-profit organization. Since principals and agents are different, there will always be a conflict between the two. Why? Because different principals and different agents will have different objectives, and that gives rise to a conflict. In case of a public company, the difference is directors want a higher remuneration while shareholders want higher return. in a public sector company, the problem is that my priorities as a taxpayer may be different than the priorities of the government officials that are actually running a public sector organization. So I might want my tax money to be used in health, but the government officials will follow the mandate that they were elected on, meaning that they will follow whatever objectives that they said they will follow when they were campaigning. So they will use my funds in maybe infrastructure or maybe education, but that's the conflict in a public sector organization. In an NFPO, the conflict is that donation money may be used for purpose that the NFPO was not made for. So now this is very important. In an NFPO, the conflict is that the donors pay money for certain objectives to be fulfilled. And if trustees are not using the money for the purpose that donors intended the money to be used, then that is a conflict in a not-for-profit organization. For example, a not-for-profit organization runs, now listen to the example carefully because you're going to be answering. So, in a not-for-profit organization runs to provide free of cost medical facility to deserving patients. If this not-for-profit organization uses donations to give orphans food and shelter, is that right? Yes or no? A simple yes or a no would do. Yes or no? Yes. No. All right. I like how you were answering in gaps, meaning that you mean no, definitively. Ethically, yes, but no. No, Amara, it has to be a simple yes or no. The answer, like most of you said, the answer is that is not right. This is not right. This is a conflict. Why? Because the donors looked at the purpose of the not-for-profit organization, which stated that this not-for-profit organization provides medical facilities to deserving patients. And if donations are being used for any purpose, however good that might be, other than medical facilities for deserving patients, then that is a conflict. That is also fraudulent, because if you're not using donors' money for the purpose that the money was taken for, then that's fraud, and that's the conflict of interest. Absolutely, your answer is right. How are we supposed to answer questions? Alina, in the chat boxes. I'm hoping that you're asking about my questions that I'm asking right now by writing down the answer in the chat boxes. I'm looking at the chat box right now. I can see who is answering. I can also see the answer that you've given. So yes, I'm looking at this. Yes, Mohsin, we will still consider it as a fraudulent activity. Why? Because this money was not taken from donors with the promise that it will be used for orphans. You took this money as a director by telling the donors that it will be used for providing medical facilities to patients. That is the only purpose that this money can now be used for ethically. All right. So this was the basic difference in the agency relationship for three kinds of organizations: a public company, a public sector company, and a not-for-profit organization. Remember, a public company is a profit-making organization whose shares are listed on the stock exchange and are traded on the stock exchange. Normal general public can buy shares of a public company, a listed company, and that's why it's called a public company or a listed company. A public sector company is a company that works for the welfare of people and is owned or controlled by the state. So the conflict in a public sector company would be that the government officials often have different objectives and will use tax money for different objectives than the objectives that are specified by the taxpayers. So I might want my money to be used for health, but the government officials will use it for whatever purpose that they were elected upon. Similarly, in donors and trustees, the conflict is that donations might not be used for the purpose that is stated by the charity or for which the charity was actually made, in which case that's fraud. All right. So let's start the basics of corporate governance, and let's start by looking at what corporate governance actually is. Now that we've looked at the basic difference between three kinds of organizations, let's look at what corporate governance actually is. So I'm just going to change it a little bit. I don't know how to. All right. All right. So now that I have more space, I'm going to start scribbling right about now. All right. Why can't I use the pen here? All right. Give me a minute. Okay, before we start corporate governance, I'm going to give a 5-minute break, and we are going to come back after 5 minutes. Please bear in mind that there's no problem with the internet right now. There's no problem with the sound. There's no problem with the screen. I need a 5-minute break. And we are going to resume after 5 minutes, and we are going to start corporate governance and delve right into the details of corporate governance. We resume in 5 minutes. Right. Why can't... All right, let's resume. I'm hoping that everyone can hear me. I have to do a sound check every time I come back from a break because apparently we keep having problems. Yes, can you send yes to Muna? All right. Can everyone hear me? Sound is clear. That's perfect. Okay, that's perfect. Hearing you clearly. All right. So I'm going to start with concepts underpinning corporate governance. Listen to this carefully. What these actually are. So sometimes, or in F8, or in the ACCA course, you will have seen that auditors and accountants, they have fundamental ethical principles that they have to follow in order to do their jobs. So an auditor is required to do his job with integrity, confidentiality, professional competence, and due care. Remember that just like auditors get a code of ethics for them to do their jobs, corporate governance is a set of principles, a set of ethics given to directors in order for them to do their job properly. Now, directors are responsible for the governance of a company. They are responsible for running a company. Remember that corporate governance is a set of principles, set of ethics that is given to directors in order to ensure that the company is governed in the best way possible. And within these fundamental principles, or within these sets of principles of corporate governance, there are some concepts that are fundamental to the principle of corporate governance. Let's look at what are the fundamental or the concepts that underpin corporate governance. Remember, if you had to summarize in a few lines what corporate governance actually is, corporate governance is a set of principles given to directors in order to specify how to run a company properly, or what is the best way to actually run a company. In these principles, some of the concepts that underpin corporate governance, or some of the concepts that form the basics of corporate governance are, number one, fairness. Now, the concept of fairness the concept of fairness says that directors must treat one stakeholder group equitably. Now, does that mean that consumers or customers are going to be treated like suppliers, or suppliers are going to be treated like shareholders? Absolutely not. The concept of fairness means that directors must treat all shareholders equally. Now, within shareholders, there are two types of shareholders. There would be institutional shareholders, or the majority shareholders, and there will be private shareholders that are going to be minority shareholders in a company. Remember, the fairness concept says that no matter what kind of shareholders they are, majority or minority, they must be treated fairly. They must be treated equitably. That means if institutional shareholders are getting certain information about the company before year end, then this same information must be disseminated or distributed to private shareholders or minority shareholders at the same time. Companies and directors must not give preference to one kind of shareholders over the others. That is the concept of fairness. Let's take another example. Within customers, there will be some customers who are major customers or more important for a company, and others that are minor or insignificant customers. The fairness concept says that no matter what kind of customer, major customer or a minor customer, all customers must be treated equitably by directors. So if directors are ensuring quality products for one kind of consumer, then the same quality product should be given to the minority or the minor customers as well. For example, Honda as a company cannot give different qualities to different markets. Now, by qualities, I don't mean different designs, because we all know that Honda as an automobile company gives different designs to different markets, and that's fine. Changing design for different markets is not being unfair. Changing the quality or the standard of your product for a different market is going to have an impact on fairness. So the concept of fairness says that directors must treat all customers equally. No matter if one customer gives more business than the other customer. So minor customers should be treated exactly like major customers are treated. Minor suppliers should be given timely payments if the company pays major suppliers on time. You must understand that the concept of fairness does not mean treating shareholders exactly like consumers. It would mean that all consumers have to be treated equitably. All suppliers have to be treated equitably. All shareholders have to be treated equitably. The company cannot give differing quality to different consumers. The company cannot ensure timely payments to major suppliers and then keep delaying payments from minor suppliers, so on and so forth. A private shareholder would be one individual making investments. So if I invest in a company in individual capacity, I am a private shareholder. One individual, me, using my funds to invest in a company, I will be a private shareholder. An institutional shareholder is a shareholder that accumulates different individuals' money and then makes an investment in a company. That it's an institutional shareholder. Now, the second concept underpinning corporate governance is transparency. And bear in mind that when we're talking about transparency, the concept of transparency applies to ways in which stakeholders can be informed. The concept of transparency means that the company should not make any effort to hide, conceal, or distort information that is given to stakeholders. Now, the company has to be transparent in the AGM. The company has to be transparent in the annual report. The company has to be transparent through press statements or press releases. These are the mediums that the company has to distribute information to stakeholders. The website is also a medium. The company must ensure that the AGM, annual report, press statement, website are all transparent. All give truthful information. All give truthful information about the company to stakeholders. Now, this is very important because transparency means transparency in reporting. Transparency means being clear, being concise, and making no effort to conceal information. How does the company do that? By ensuring that it uses AGM, the annual report, the press statements, and the website productively in order to ensure that information is distributed on a timely basis to all stakeholders. So that's transparency. Next concept underpinning corporate governance is independence. Now, corporate governance realizes that certain parties within an organization have to be independent. The first party that has to be independent within an organization is non-executive directors. The second is external auditors. So, external auditors. You will have to pardon my excessive use of abbreviations. I use them, it's just a force of habit. I will specify whatever abbreviation that I'm using as I go. All right. The third important entity for whom independence is of extreme importance is internal auditors. So remember, when you're talking about independence, you're talking about three major parties that are required to be independent within an organization. The non-executive directors, who have to protect shareholder interest on the board of directors. The external auditors, who have to give an opinion on financial statements. And the internal auditors, who have to check internal control systems primarily. The internal auditors are responsible for several other things, but primarily when we're talking about internal auditors, we talk about their ability or their duty to actually check internal control systems, check the design and implementation of internal control systems. Now, corporate governance realizes that executive directors, for example, the CEO, the CFO, and all other executive management team in a company cannot be independent of the company because they earn a remuneration from the company. So corporate governance says independence, as in being free from influence, is of importance to non-executive directors who represent shareholder interest on the board of directors. Independence is important for external auditors who are going to be giving an opinion on the truth and fairness of financial statements and hence have to be independent, and the internal auditors who have to check the design and implementation of internal control systems. Am I talking about the degrees of independence? I am not. I'm just talking about three parties that are required to be independent. Are internal auditors less independent than external auditors? The answer is yes. External auditors are more independent than internal auditors because internal auditors are appointed by the audit committee, they are appointed by the board, and they cannot be as independent as external auditors. But is there a basic requirement for auditors to be free from influence or to conduct their activities with independence and being free from influence of management? The answer is yes. So three parties for whom independence is extremely important are non-executive directors, external auditors, and internal auditors. The next concept underpinning corporate governance is the concept of honesty and the concept of probity. The concept of honesty means telling the truth. The concept of probity means investigating the truth. There is a difference. Now, what is the difference between the two? I am going to explain this using an example. Please listen to the example carefully and then tell me whether you understand honesty and probity. All right, let's take the example of a CFO who does not know how financial statements are being prepared by the finance manager. The finance manager knowingly and intentionally distorts the profit figure and reports it to the CFO. The CFO does not know that the profit figure has been distorted, and he reports these financial statements to the board, who pays the CFO a bonus. The CFO gets a bonus based on profit. Now, the finance manager distorts the profit figures, makes the financial statements, and gives them to the CFO. The CFO forwards these financial statements to the board and gets a bonus based on profit. Tell me, can anyone tell me in the chat boxes, all of you, I want you all to pay attention. I want you all to answer. Tell me, did the CFO, just the CFO, breach honesty or probity? Was the CFO dishonest or did he breach probity? One word answer. Honesty or probity? Regina, you will have to answer in more than yes or a no. You'd have to say whether probity or honesty. All right. Most of you are right. The CFO was not dishonest. I'll tell you why. Because he did not know that the profit had been distorted. The CFO was not dishonest because he did not distort the profit figure. What he did was, without investigating the profit figure, he forwarded it to the board. He breached probity. He was not dishonest. Now listen to this carefully. Now tell me, finance manager, was he dishonest or did he breach probity? Tell me the same for the finance manager. Was he dishonest or did he breach probity? He was dishonest. You're absolutely right. The finance manager was dishonest because he distorted the profit figures. So, probity means investigating the truth. The CFO breached probity because he did not care to find out how the profit was earned until he was getting a bonus based on profit. The CFO was not dishonest because he did not distort the profit figure. The finance manager did. The finance manager was dishonest because he distorted the profit figure. The CFO breached probity because he did not investigate to find out how profit was earned in that particular year and got a bonus anyway. Honesty means telling the truth. Probity means investigating the truth. Transparency means clear, concise information on time to stakeholders. The finance manager was dishonest, absolutely. And the CFO breached probity. All right, we're going to move to the next concept, the concept of responsibility and accountability. All right, so these are the two concepts. The concept of responsibility says that directors owe a fiduciary duty to shareholders. Directors owe a duty of care, a duty of responsibility to shareholders. Why? Because shareholders have appointed directors to run the company on their behalf. So it is the director's responsibility to ensure that the company is run using exactly the concepts or the principles that the shareholders want it to be run on. That's the responsibility of directors. Now tell me, will responsibility ever be fulfilled if there is no accountability? Yes or no? Yes, Mohsin, transparency only refers to disclosures. Now answer the question. Can responsibility be fulfilled if there is no accountability? Absolutely no. I like how Fawad has put a degree on it. Obviously not. Bilal, absolutely right. No, not usually. Well done, Umar. Absolutely. You guys are all right. So the concept says, concepts underpinning corporate governance say that it is not okay to just delegate responsibility. To delegate responsibility properly, directors will also be held accountable for their actions. How do shareholders hold directors accountable for their actions? Can anyone tell me? How do shareholders hold directors accountable for their actions? Through, I will give you one hint, through AGM. So every year, the directors will be called to justify their actions to shareholders in a direct face-to-face meeting through the AGM, through financial reports. Well done, Naveed. Yes, through the annual report. Anything else? Appraisal. Well done. Who said that? Sikandar. You're right. Sikandar, yes, I can. I'm reading each and everybody's comments. There are a lot of you. So if I'm not pointing you out, that does not mean I can't read it. I can. I will get to it. We have 5 days. By selling shares, Azmina, you're absolutely right. By not electing them in the AGM, absolutely right. So listen to this carefully. So the concepts of corporate governance say it is not okay to just delegate responsibility to directors. The directors will also need to be held accountable for them to fulfill their responsibility. So responsibility means that the directors owe a fiduciary duty to shareholders. Accountability means directors must be held accountable. Directors must be questioned on whether they were able to fulfill their responsibility to shareholders or not. The next concept underpinning corporate governance is reputation. Now, the next concept is reputation. This means that, or corporate governance says that directors must take all decisions necessary to protect reputation of organization and directors themselves. So, the concept of corporate governance also says that directors must take all decisions that are necessary to protect their own reputation and the organization's reputation. So, corporate governance goes beyond making profits. So, the concepts of corporate governance say that only making a profit is not enough. A good director wants to protect the company's reputation and his own reputation through every decision that he takes. Why? Because there are certain things that are very important and are linked with the reputation of an organization. All right, answer in the chat boxes. Can you tell me if the reputation of an organization is not healthy, it is not positive, what does it affect? For an organization that has a poor reputation in the market or a poor reputation in front of stakeholders, what would be the impact on the organization? It will affect the share prices, absolutely. So the price of shares will go down. The share price, it will affect profits, well done, excellent. Goodwill reduced, lose credit benefits, even going concern, collapse of company, absolutely. And these are all correct answers. And corporate governance says directors do not have one primary objective of profit maximization. Directors must ensure that they are protecting the reputation of the organization as well, because if they don't, ultimately share price will be affected, profits will be affected, and the long-term survival of the organization will also be affected. The next is, yes, I am loss of customers. Talha is absolutely right. The next is judgment. All right. And this is very important. Listen to it carefully. Judgment means taking a balanced view of decisions. Taking a balanced view of decisions. It also means making informed decisions based on facts. Both of these things mean judgment. Now, the concept of judgment is that a director must exercise informed judgment in decisions. So, how does a director make an informed judgment? A director must not base decisions, according to corporate governance, on gut feeling. A good director makes an informed decision based on facts and figures that are presented in the board of directors by other directors. A good director also ensures that in one decision, he is not basing decisions solely on profit. A good director takes a balanced view of every decision, and a balanced view would mean looking at risk, looking at reputation, looking at profit, looking at the short-term survival of the organization as well as the long-term survival of the organization. That is judgment. That is also balanced judgment. Judgment would not mean only looking at profit. Judgment would mean taking a balanced view of decisions and looking at all aspects that affect a decision. For example, risk, for example, short-term survival, for example, long-term survival of the organization. That is judgment. The last concept underpinning corporate governance is integrity. And the concept of integrity summarizes or includes all concepts that were covered. So integrity would mean dealing with honesty. So all directors should be honest, and that's integrity. Dealing with transparency, so reporting with transparency, that's also integrity. Integrity would also mean exercising balanced judgment. Integrity would mean several things. Remember, integrity is one concept and it is included at the end because it summarizes or it includes all concepts that we've covered up until now. So a director that deals with fairness, a director that ensures transparency in reporting, a director that is independent, a director that exercises judgment is said to have fulfilled his responsibility with integrity. So integrity is one word that encompasses all of these concepts. Hemraj, there is no difference between integrity and honesty. Integrity and honesty are one and the same. Integrity is a broader term that includes honesty as well. Fairness would mean then that all stakeholder groups must be treated equally. That doesn't mean that consumers have to be treated like suppliers. That means all suppliers should be treated equitably. The directors should not make a difference between suppliers based on the fact that they are majority suppliers or significant suppliers or insignificant suppliers. If a company is ensuring timely payments to its significant suppliers, it should have the same policy towards its smaller or insignificant suppliers as well. Now, I have a question lined up for you based on concepts underpinning corporate governance. If you open the second handout that has been uploaded, Nawal, again, all of them are not going to be covered. Skepticism means having a negative eye, but like I said, all of the concepts are not covered over here. The concepts have been summarized in the summary notes that are going to be forwarded to you at the end of the session. Like I said before, it is impossible for me to cover each and everything in 15 hours. So what I'm going to do is I'm going to be covering all important topics. That's my promise to you. And the topics that I'm not going to be covering, the revision notes are going to be covering. So the revision notes, I'm going to be forwarding a 100-page revision note summary to you for you to go through before you sit for the exam. So they're going to be covering everything. The second handout is a practice material. It's a Word document. It says day 1. And we are going to be doing the first question. Now listen to this carefully because I'm going to be discussing the requirement with you. We are going to be covering this. All right. This is June 2014, question number 1, part A. All right. Now I'm going to be deconstructing the requirement for you. Please listen to this carefully. The underlying principles of corporate governance include transparency. You should have underlined this. Judgment, reputation. So 1, 2, 3. Done. Explain these 3 terms. This is the first part of the requirement, and assess Zaza Board's performance against each one. This is the second part
of the requirement. This part carries 3 marks. And this part carries 6 marks. All right. This is not working for some reason. 6 marks. All right. So the first part of the requirement carries 3 marks, and the second part of the requirement carries 3 marks. Oh, sorry. 6 marks and 3 marks. All right. This is working again. Now my pen stopped working in between. I'm just getting to it right now. All right. Now the verb is assess. Assess would mean you would have to give your conclusive answer whether you think Zaza was transparent, whether you think Zaza exercised judgment, and whether you think that Zaza took appropriate decisions to protect its reputation or not. All three are extremely important. So transparency, judgment, and reputation. They are extremely important. Now, why have I underlined these three? Because in exam conditions, students are most likely to actually forget about one and write about two. What you do is you clearly underline them on your question paper and you number them so that you remember that there are three concepts for you to cover: transparency, judgment, and reputation. For 1 mark each, you're going to be explaining what they mean. And for 2 marks each, you're going to be assessing Zaza board's performance against each one. So you will have to conclusively answer SN to have the wrong information. It's not up to you. The marking guide, it comes with the past exam papers. It is not up to you to make the marking guide. All right. So in transparency, you will have to say whether Zaza's board was transparent. You will have to say whether Zaza's board exercised judgment. And you will have to say whether Zaza's board took adequate steps to protect its reputation. You have exactly 5 minutes, or since this is the first question, I'm going to give you 10 minutes. For those of you who are asking for a prayer break as well, now is the time for you to pray and read the question. I know the time is less, but I'm sorry, we will have to bear with that. That's because our session already started with a delay. So you have 10 minutes to read this question. It is 7:34 right now, and we resume at 7:44 exact. So hurry up, read it, and we are going to discuss the answer very, very quickly. I'm not going to be spending a lot of time actually discussing the answer. So we are going to do a quick overview of the answer, and then we are going to go on to the next topics. All right. So I'm hoping that everyone was able to read the question. Confirm if you were able to read the question, and remember, every time that you practice P1 at home or anywhere, please read the case study in a time-constrained environment. You have to make sure that you are reading the case study in a time-constrained environment. You should never ever take more than 10 minutes to read an entire case study. That's how you should practice. That's how you must practice. All right. So we are going to start. Let's start discussing. There were 3 concepts that are being tested. All right. Judgment was not the first one. The first one is transparency. So transparency. Then there is judgment. And then there is reputation. All right. So let's look at transparency first, and then we are going to look at judgment and then reputation. So to explain transparency, you would probably say that transparency means being truthful and being clear, concise, and being on time with all information or communication that is meant for stakeholders. Transparency is ensured through AGN, annual report, press releases, the website, so on and so forth. So in the chat boxes, can everyone confirm? What do you think? What is your assessment? Was Zaza's board transparent in its communication with its stakeholders? Yes or no? Just a simple yes or no would suffice. Was Zaza's board transparent in its communication with its stakeholders? I like how there's a mixed badge, and the correct answer to this question was yes. Zaza's board was in fact transparent in its communication with the board. I'll tell you why. How do you justify your answer? You will have to write that Zaza made no effort to conceal information from stakeholders. It also justified actions through CEO's statement to press and statement through investor relations department. So the fact remains that Zaza's board made no effort to actually hide the justifications behind its decisions. The fact that Zaza chose to stay in a market when 2 other companies withdrew was because Zaza wanted to capitalize on a profitable opportunity. The CEO gave the exact same justification when asked by pressure groups in a press release, and the same statement was then explained through a statement given to the stakeholders by the investor relations department. So the answer is that the company made no real effort to conceal or distort the reasons why they took this decision in any of its press releases or statements that were given to stakeholders. Now, this question only clearly asks that was the company transparent or not? And the answer is yes, the company was transparent. It made no effort to conceal or distort information that was given to stakeholders. The next is, did the board of Zaza exercise balanced judgment in its decisions? Please give your assessment. Yes or no? Come on, everyone has to participate, even those who haven't been participating up until now, in your chat boxes, yes or no. And I like how the answer to this question is a unanimous no, except for Evan, who has said yes, and Rebecca, who says yes as well. Actually, the correct answer is that the board did not exercise balanced judgment because it only considered profit, disregarding long and medium term risks. So in balanced judgment, remember, balanced judgment would mean taking a balanced view or giving a balanced perspective on a decision. From the case scenario, it seems that Zaza's board only ever considered profit in its decision to stay in the market when two other companies withdrew. This shows that the board failed to make balanced judgment where they only considered profit and disregarded medium and long-term risks, which ultimately damaged the company's image as well. So the answer is no, because they only considered profit. Yes, Usman, you're absolutely. Also disregarded reputation. Umar, yes, that can be the answer, but you will then have to repeat your answer in reputation. We are just going to discuss that. Fawad is absolutely right as well, considering social or ethical responsibility. Well done. So the last term is reputation. Did the company take ample steps or sufficient steps to protect its reputation? The answer is no, it did not. Why? Because the company stayed in market when two companies withdrew and that looked opportunistic and overreaching for the companies. Withdrew and stakeholders believe that the company believed in making profit at any social cost. All right, now this is important. What you have to remember and what you have to mention in this answer is that the company chose to stay in the market even though two companies withdrew from the market in order to protect their reputation. Did the company take ample steps to protect its reputation? The answer is no, because it did not make any effort to hide the fact that the company only did this for profit. That was extremely opportunistic of the company because they served their own interest and believed at making a profit at any social cost. That is the answer. Now, more important than this answer is the fact that when you're writing down the answer, you have to make exactly, and you have to remember this exactly like I say. All right. This is slightly slow now. All right. Exactly like I say, you have to attempt this exactly like I say. Please remember that you have to answer this question in 6 paragraphs. Right? You have to give a heading of transparency first. Then you have to take 1 paragraph to explain transparency, 1 for assessment, so on and so forth. Then you will give the heading of judgment. Then you will take 1 paragraph to explain judgment and 1 for assessment. Then you will give the heading of reputation. You will take 1 paragraph for explanation of reputation and 1 for assessment. That's how you're going to answer. So for 1 mark, remember, in the exam, please don't write more than 3 sentences. For 1 mark, you can write a maximum of 3 sentences in your exam. If you're writing more than 3 sentences per mark, then you're overwriting and you're losing focus. So when you have to memorize this, please remember you have to write a maximum of 3 sentences per mark. Am I saying that you must write 3? Absolutely not. In certain cases, you can write 1 sentence for 1 mark, and that would be correct. That would get 1 mark as well. But remember, in order to get that 1 mark, you have to write in a focused fashion, and you have to stay to the point, write in a simple structured sentence, and get that 1 mark. Maximum of 3 sentences per mark, but you can write 1 sentence per mark as well if you are making sure that you are explaining everything properly. So that's how you're going to answer. How many per mark? How many sentences per mark? 3 sentences per mark. All right. So I'm going to go back to the slides, and we are going to start covering structure of the board. All right. Before I start covering structure of the board with you, I'm just going to cover a slight structure with you, or summarize the structure with you according to corporate governance. So corporate governance, we just did the concepts underpinning corporate governance, or the fundamental principles of corporate governance. Remember that corporate governance, this is true. Gives guidance on 3 things within your syllabus. It gives guidance on the structure of the board. It gives guidance about the subcommittees of the board, and it gives guidance about internal control systems within an organization. Now, what you can do is remember that throughout corporate governance, whatever topics that we are going to be covering them within the board structure, the subcommittees of the board, and the internal control systems. I'm just going to summarize them for you, and then we are going to do the details of them one by one. All right. So the first is the board structure. According to the principles of corporate governance says there should be 2 types of directors on the board. All right. So I'm just going to erase subcommittees because I need some space. Actually, I'll just leave it be. But remember, according to the principles of corporate governance, there are 2 types of directors that are required to be on the board of directors. Those 2 types are executive directors and non-executive directors. Now, let's first look at the difference between executive directors and non-executive directors. Remember, executive directors are those who run the operations of a company. So within the executive management team, I'm just going to close down some Word files so that I have less. All right. So remember that within 2 types of directors, corporate governance talks about executive directors and non-executive directors. Remember, corporate governance says executive directors run the operations of a company, and an example of executive directors would be the CEO, CFO, marketing head, so on and so forth. So all of these executives are responsible for running the operations of a company. Non-executive directors do not participate in running the organization. What they do is they represent shareholder interest on the board of directors. So non-executive directors are independent of the operations of the company, and what they do is they represent shareholders' interest on the board of directors. Executive directors run the operations of the company, and they earn remuneration for doing so. So the CEO, the CFO, the marketing head all earn remuneration from the company, and they run the company on shareholders' behalf. What do the NEDs do? The NEDs are responsible for protecting shareholder interest on the board of directors. They do not participate in running the organizations. Rather, they are there on the board of directors to actually protect shareholder interest. How do they do that? NEDs are supposed to be independent. Their roles are several. I'm just going to erase to remove confusions from this. And we are going to study the roles of non-executive directors. Remember, non-executive directors are required to be independent of the company's operations. So what do they actually do on the board of directors? If they are not running the operations of the company, what do they actually do on the board of directors? What you need to remember is that non-executive directors are required to be independent. How are they independent? We are going to get to that in a moment. What you also need to remember is that non-executive directors are there to protect shareholders' interest on the board of directors. So their roles, the roles of non-executive directors are 4 primarily. The first role is with regards to strategy. The second role is with regards to performance. The third role is with regards to risk. And the fourth role is with regards to people. So a non-executive director will have 4 primary roles within an organization. Let's see what those roles are. The first role, like I said, was strategy role. So within a strategy, a non-executive director is required to participate in strategy and challenge, scrutinize strategies. So what a non-executive director is going to do is make sure that in every decision that is taken by the board of directors, the board of directors not only consider the company's perspective, but also the shareholders' perspective. The non-executive directors are there on the board of directors to ensure that shareholders' interests are represented, and in every decision that is taken by the board, it is ensured that shareholders' interests are protected. So if the executive directors bring a proposal of a strategy to the board of directors, it is the non-executive director's job to ask questions regarding strategies and ask the executive directors to actually prove to the non-executive directors how a certain decision is best for shareholders. You have to listen to this carefully. Executive directors propose strategies because they have inside knowledge of the business's operations. Non-executive directors ask why, how, when, and who will do it. Why are they asking these questions? To protect shareholders, to make sure that every decision is not in the best interests of executive directors, but in the best interest of shareholders who are the fund providers. That is non-executive director's job. Please tell me that you understand. Yes, no? In the chat boxes, tell me that you understand what non-executive directors do with regards to strategy on the board of directors. All right. Now, remember, non-executive directors don't only participate in decision making. They also ask questions about strategies. They ask executive directors to prove to them how certain decisions are actually in the best interests of the shareholders and not just the executive directors. So for example, if I am the executive director and I say that it is in the best interests of my company to open a subsidiary in Pakistan, for example, then it is the non-executive director's job to ask executive directors how opening a subsidiary in Pakistan is going to be in the best interests of shareholders who are the fund providers for this decision. So they scrutinize and challenge decisions so that executive directors have to prove to non-executive directors how their strategies are going to be in the best interests of shareholders and the fund providers. No, Bilal, I haven't gotten to that point where I would say that non-executive directors oversee the executive directors. Just remember that non-executive directors are there to challenge strategies, to participate and challenge strategies. The second is performance. Now, what non-executive directors also do on the board of directors is lead the performance appraisal process. Now, listen to this carefully and answer the question. In a department, normally, when subordinates are going to be appraised, the department head is going to appraise the subordinates, right? So the CFO, the head of the finance department, is going to be appraising the finance team. The CEO is going to be appraising all other department heads within an organization. But can you tell me who appraises the CEO's job, or who appraises the CEO's performance? Can anyone tell me? So within an organization, if I am a subordinate, I am going to be appraised by my head of department. But what if I am the head of department myself? Who appraises me then? The non-executive directors. Your answers are absolutely right. Absolutely right. So within the board, the appraisal of executive directors is conducted by non-executive directors. So for this, you have to remember this chart. So within the board, the chairman heads the performance appraisal process. The chairman appraises the CEO. The CEO appraises all executive directors. The chairman is appraised by non-executive directors, and all non-executive directors appraise the chairman as well. So this is a two-way process. The chairman will appraise the non-executive directors, and the non-executive directors will appraise the chairman as well. The chairman appraises the CEO, and the CEO appraises all executive directors. So if I'm going to ask you who heads the appraisal process within an organization, the correct answer is non-executives. Can anyone tell me why don't the shareholders appraise all executive directors? Can anyone tell me why can't shareholders appraise the executive directors? Why do they have to appoint non-executive directors so that they can appraise the performance of executive directors? Not practical. Joanna, can you explain that further? Shareholders are too many. Maybe they don't know how. Absolutely. All of your answers are absolutely correct. They're not qualified because all shareholders are A, too many, and B, they will normally not have the expertise to actually conduct performance appraisals themselves for their own agents. So they hire expert non-executive directors on their behalf to actually appraise the performance of executive directors and give them reports on a regular basis. Remember that. Non-executive directors are not above executive directors, do not have a higher legal status than executive directors, but non-executive directors do head the performance appraisal process simply because there is no other individual within the organization who can appraise the executive directors. And since shareholders can't do it themselves, they hire non-executive directors to do it on their behalf. Absolutely, Abdullah, we can say that. So does everyone understand why non-executive directors actually head the performance appraisal process? It is absolutely not meant to indicate that non-executive directors are there to supervise executive directors. Absolutely not. But since executive directors cannot be appraised by anyone else, yes, absolutely, Fawad, both are agents of shareholders. But since executive directors cannot be appraised by any other individual, this task has to be performed by non-executive directors who are representing the shareholders. So, do you understand? Yes, no? Everyone? All right, that's perfect then. Let's move on to their next role. So, their next role within an organization for non-executive directors is risk. Can anyone tell me? Risk would require resources. And one of that very important resource is money, finance. So, money or finance. So tell me, how much risk should an organization bear? Can anyone tell me how much risk should an organization bear? Anyone? Can anyone tell me how much risk should an organization bear? Depending on its resources? Can anyone tell me how much risk should an organization bear? How much shareholders want their directors? An organization can only take as much risk as the finances allow, right? Which means an organization should take as much risk as shareholders want. Because remember, if I am the shareholder, an organization can only take as much risk as I want because it is my money that they are going to be using in risk taking. So, why should non-executive directors be responsible for identifying and managing risks? Because they represent shareholders. They represent those people who are providing finances for risk taking. So non-executive directors participate in risk identification, and I've written it over here, risk identification, addressing. Why? Because risk will be taken using shareholders' funds. And who should tell the company how much risk to bear? The non-executive directors, who are there to represent the shareholders. Remember, non-executive directors participate in risk-taking because they represent how much risk shareholders are willing to take. Because as the CEO, I might want to take a lot of risks. But as the CEO, I have to understand that it is not my money that is going to be used in risk-taking. I must listen to shareholders. I must take as much risk as shareholders are comfortable with. And who is going to tell me how comfortable shareholders are with risk-taking? The non-executive directors. And that's why non-executive directors need to participate in risk identification and risk addressing, because they are the ones who are going to tell executive management team how much risk shareholders are willing to bear. Do you understand, all of you, why non-executive directors participate in risk-taking? I am not using the words risk appetite or acceptability level, because those are the terms that we are going to be considering in detail when we do risk. You just have to understand why non-executive directors participate in risk identification. Their role is to participate because they know how comfortable shareholders are with risk. Because shareholders' interests are represented by non-executive directors. Every time shareholders want to communicate to the board, they will communicate through non-executive directors. We're talking about both. Financial risk is an example, Usman, of business risk. So I'm talking about business risk. All right. So within risk, non-executive directors will help in risk identification plus its addressing. So what to do about risks? Why do they participate? Because they represent shareholders' willingness to take risk. Next, their people role. Non-executive directors bring contacts to the board. So every time the board needs to negotiate with external parties, you have to understand that non-executive directors can help in this by using the contacts that they bring to the board. So non-executive directors will have contacts in pressure groups. You will hire non-executive directors being aware of the fact that they can bring contacts to your decision making. So they can negotiate on the board's behalf with suppliers for credit terms. They can negotiate on the board's behalf with pressure groups in order to ease pressure on the organization's activities. They can negotiate on the organization's behalf with shareholders so that shareholders are willing to provide further finance to the company. In people capacity, in the people role, non-executive directors will bridge the communication gap between shareholders and the board. Who bridges this gap? The non-executive directors. Because remember, shareholders trust non-executive directors. Non-executive directors are independent, and that's why shareholders trust them. Since shareholders trust non-executive directors, they will communicate their wants to the board through the non-executive directors. Since non-executive directors are independent, they are more trustworthy than executive directors. So every time an external party wants to negotiate with the board, they will do so through the non-executive directors. So remember that non-executive directors bridge communication gap between the board and the shareholders, and the board and external parties like pressure groups and suppliers. So non-executive directors have 4 roles in total. Just to summarize this, and please listen to this carefully, non-executive directors are supposed to A. Participate and challenge strategies. B. They're supposed to appraise and lead the appraisal process of executive directors on the board of directors. C. Non-executive directors are supposed to help in risk identification and the addressing of risks, because they are the ones who represent shareholders' willingness to take risk. Non-executive directors will ensure that the business is only taking as much risk as the shareholders are comfortable with. And the last, non-executive directors provide important contacts to the board of directors. So they will act as intermediaries between the board of directors and shareholders, and the board of directors and outside third parties. Those are the roles of non-executive directors on the board of directors. Now, how are non-executive directors kept independent of the organization and its operations? Remember, these are the criteria of independence of non-executive directors. The first is, non-executive directors should not have been an employee in the last 5 years. So let me specify that a CEO, who retired last year from an organization cannot be hired as NED. Can anyone tell me why? Why is a newly retired CEO not considered independent enough to be an NED? Can anyone write down in the chat boxes? So in the chat boxes, can anyone tell me why newly retired CEO cannot be a non-executive director? Because it makes a conflict of interest, because he will be influenced by his colleagues. Absolutely. All of the answers are correct because he has been controlling the operations of the business recently. So the 5-year benchmark is to give ample time to the CEO to regain independence, and then you can hire an ex-employee after 5 years of having terminated employment. So an NED will only be considered independent if 5 years have lapsed after the retirement of a non-executive director. The second is that a non-executive director should not have had any business relationship with the company in the last 3 years. So the CEO of a major supplier cannot be an NED. So the CEO of a company's major supplier cannot be an NED in an organization. Can anyone tell me why? Why can't the CEO of a major supplier be an NED in an organization? Chat boxes, everyone. I want to know that you guys are awake and answering. Can anyone tell me why can't the CEO of a major supplier not be, why can't the CEO of a major supplier be an NED in an organization? Conflict of interest. Because remember this and listen to this carefully. Because the CEO of a major supplier will represent his own company's interests rather than the shareholders' interest. For one NED to represent shareholders' interest, remember that NED cannot have his own interest in the company. Being the CEO of a major supplier, you have your own interest in the company rather than representing or protecting the shareholders' interest. Absolutely. Well done. They should not have any family members in senior positions in the company. So you cannot be an NED in an organization if your father, brother is the CEO of that organization. Why? Because you're too familiar with your father or your brother or the CEO of the organization to actually scrutinize their decisions. Remember, if you are an NED and your father or a family member is the CEO, you will be appraising their performance. You will be challenging their decisions. And you cannot do it if you're not independent of them. So absolutely yes, Samad, your answer is correct. Fawad, your answer is correct as well. And Syed is correct as well. I don't know how to pronounce most of the names, but I'm reading them and I'm absolutely trying to address each and every question that's coming up. All right. So an NED is not considered independent who has been on the board for more than 9 years. Why? Because too familiar with executive directors, and then they won't be able to challenge the executive directors. They won't be able to appraise the executive directors. So that's why it is important that an NED should not have been an employee in the last 5 years. An NED should not have had a business relationship in the last 3 years. An NED should not have any family members in important positions within the company. And an NED should not have been in the board for longer than 9 years. All right. An NED also, for an NED to be an independent, an NED is only remunerated with a fixed fee for director duties. Remember, they are paid a fixed fee for number of meetings attended. So one of your questions was, can an NED buy shares or share options? Absolutely not, because in that case, then the NED would not be independent because they will have financial interest in the organization. So in order to protect the NED's independence, it is important that NEDs are not remunerated, they are not given shares, they are given a fixed fee for the number of meetings attended. All right. The next is an NED cannot hold cross-directorship. This is where directors of two companies sit on each other's boards as NEDs. Now, I'm just going to give you a small example of cross-directorship. Listen to this carefully and you tell me, what do you think, why do you think is this a problem as far as independence is concerned? All right. So there are two companies, let's suppose one's ICI and the other is Pepsi. And there are two directors, Director A and Director B. Director A is an ED, Executive Director in ICI. Director B is an NED in ICI. Same Director A is an NED in Pepsi and an Executive Director in, and B is an Executive Director in Pepsi as well. This, by the way, is cross-directorship. Can anyone tell me why this is a problem? This is called cross-directorship. Why is this a problem? Can anyone tell me why is this a problem? Absolutely. Sikandar is absolutely correct. Usman's correct. Neelam is correct. Conflict of interest. You can't just answer in conflict of interest. You have to explain. They will favor each other. Usman's correct as well. Give favors to each other. Chances of collusions between them, Vikas is absolutely correct. All right. T is absolutely correct. Tasneem is correct. Absolutely, all of your answers are correct. What would happen is A and B will give favors to each other on each of these boards, because A is in a position to favor B in Pepsi and B is in a position to favor A in ICI. This is cross-directorship and that's why it hurts independence. Any NED representing the views of a major shareholder would not be deemed to be independent. Remember, NEDs are not supposed to represent one shareholder or major shareholders. NEDs should represent all shareholders at one time. So one NED cannot represent one shareholder, rather they should represent all shareholders as a group. And that's how they're kept independent. These are the criteria of independence for non-executive directors in the board of directors. Now, let me go back to the initial summary of corporate governance and see where we were at. All right. Okay, I cannot scroll. Hold on, you'll have to give me a moment. I have no idea why this is behaving the way it is. Okay, I'll just open a new file. So, right about some time back, what we did was that corporate governance gives guidance about three things on the board of directors: the structure of the board, the subcommittees of the board, and internal control systems. Within the structure of the board, the first thing that we did, and the first thing according to corporate governance, was that the board of directors should have two types of directors: executive directors and non-executive directors. The second guidance of corporate governance on the board structure is that the board should have one chairman and CEO whose roles are segregated. So, one person cannot hold, according to corporate governance, the position of CEO and chairman of the board. corporate governance says, or the principles of corporate governance say, that chairman and CEO roles should be segregated. And corporate governance also says that the chairman will be responsible for running the board, while the CEO will be responsible for running the company. How does the chairman run the board? It's important because the chairman has the casting vote. What does the casting vote mean? Remember, the casting vote means veto power. Chairman of the board runs the board. How? Because he has the casting vote. He has the veto power. The CEO runs the company because he's heading all heads of departments. He's effectively heading all executive directors within an organization. Corporate governance also says that the chairman of the board should be non-executive. So he should be independent. The chairman of the board should be non-executive. Remember, I'm not using the word non-executive director. I'm saying the chairman of the board should be non-executive, and that's because the chairman of the board, since he has veto power, should be independent. So the chairman of the board should be independent. How is the chairman of the board kept independent? By ways that we just did. The chairman of the board should not have been an employee in the last 5 years. The chairman of the board should not have had any business relationship in the last 3 years. The chairman of the board should not have any family members that, in executive management team. He should not have any cross-directorship, and the chairman of the board cannot be provided a remuneration by the company. So a chairman of the board gets a fixed fee exactly like other non-executive directors do. Is he a non-executive director too? No, he is a non-executive chairman. He is not a director. He's a chairman of the board. So corporate governance says CEO and chairman should be two different people with two different sets of responsibilities. Let's now do what the chairman will be responsible for and what the CEO will be responsible for. So corporate governance says that two different people should hold the positions of chairman and the CEO within an organization. We will first consider what a chairman is responsible for, and then we will consider what the CEO of the board of the company is responsible for. The chairman is responsible for two things: shareholders and the board. All right. For shareholders, the chairman of the board does two things. He communicates and the board of directors. So you have to look at this carefully. The shareholders communicate with the chairman of the board, who then communicates their requirements to the board of directors. That has executive directors and non-executive directors. So every time shareholders want to communicate with the board, they are not going to be communicating directly. What they are going to do is they are going to communicate with the chairman, and the chairman of the board is going to communicate with the board of directors. That has two parties: executive directors and non-executive directors. That's how information and communication will flow from the shareholders to the board of directors, and from the board of directors to the shareholders through the chairman of the board. All right. So as far as shareholders are concerned, it is the chairman's responsibility to communicate with the shareholders and represent the company in front of the shareholders. He's the public. So every time press wants company to justify actions, they will ask the chairman to give a statement. Can anyone take up the statement? Every time the press wants to hold the company accountable, every time general public. So, can everyone hear me properly? Can all of you hear me? Yes, no? No. Can you write this down? Voice distortion. All right. All right. We'll sort that out. Hold on. Right. Can you guys all hear me? Perfect. That's perfect then. All right. So what I said was that chairman is going to bridge the gap between shareholders and the board of directors. Every time shareholders want to communicate with the board of directors, they're going to communicate with the chairman first, and the chairman is going to communicate with the board of directors that has executive directors and non-executive directors. Yes, I'm repeating that. All right. So remember that the chairman of the board is basically bridging the communication gap between shareholders and the board of directors. So every time the board of directors needs to be communicated something by the shareholders, they are going to first talk to the chairman of the board and then the board of directors themselves. So you have to understand that the chairman of the board is essentially bridging the communication gap between shareholders and the board of directors. Now, listen to this carefully, answer the question. Every time the press or normal general public wants to hold the company accountable for their actions, they are going to ask the chairman to release a statement. Why not the CEO? Why should chairman be the public face of the company? Why can't CEO be the public face of the company? Why is it the requirement of public and normal general shareholders for the chairman to be the public face of the company? Why can't the CEO do it? Independence. Naval is absolutely right, because he is non-executive, and understand that he is more trustworthy than the CEO. Remember that. The press is going to trust every statement that comes from the chairman rather than the CEO, because they know that the chairman is a non-executive and he is to be trusted more than the executive directors. That's why. Because he is independent. Absolutely. Talha, you're absolutely right. Because he represents the interests of shareholders. Remember, every time press and shareholders want the chairman to represent the company, that's because they know that the chairman is independent, and every statement that the chairman is giving to the press and the shareholders will inherently be more reliable because he is independent. So, the chairman will communicate with the shareholders and will be the public face of the organization. I'm just going to erase extra things that I've written over here. Apparently this is not working. Right, I'm just going to erase this, and let's see that what the chairman of the board does for the board of directors as well. All right. So the chairman of the board is responsible for what within the board? Okay. So within the board, the chairman of the board is responsible for ensuring effectiveness of the board. How does the chairman ensure effectiveness of the board? Remember, the chairman of the board ensures that the board is meeting regularly. So regular meetings. The chairman of the board will also ensure that the board meets with proper agenda plus minutes. The chairman of the board will also ensure that the board has sufficient information for decision making. So all of these three things, 1, 2, and 3, are ensured by the chairman of the board. So the chairman of the board is going to ensure that the board is effective. How? By ensuring that there are regular meetings of the board of directors. So in a company, as and when, every time a major decision is brought to the board for evaluation, the chairman of the board ensures that there is a meeting of the board of directors rather than just executive directors who are going to be discussing it. So he will ensure that there are regular meetings of the board. He will also ensure that the board meetings have proper agenda plus minutes. Does he maintain minutes? Absolutely not. That is the company's secretary. But does he ensure that there is an agenda and minutes? That is the responsibility of the chairman. He will also ensure that the board is exercising proper judgment by ensuring that there is sufficient information present for decision making. The chairman of the board also leads the appraisal process of the board. How? Through this. So the chairman of the board is leading the appraisal process because at the top of every appraisal activity, the chairman is heading the appraisal activity. How? He is going to be appraising the CEO, who appraises the executive directors. He's also going to be appraising the non-executive directors, and the non-executive directors will appraise the chairman of the board. So how does the chairman ensure that the board is effective? By regularly appraising or by regularly leading the appraisal or the performance evaluation process. All right, this minutes is whatever the board decides, it should be documented. The decisions of the board in a particular meeting are called minutes of meeting. That document in which every decision is written is called minutes of board meetings. That's the answer to your question, Tasneem. All right. So he leads the appraisal process. He also ensures regular CPD. Now, can anyone tell me what is CPD? Can anyone tell me what CPD is? Please don't write continuous professional development. I don't want you to tell me what it stands for. No. So, wrong way of asking the question. No, I know that it is continuous professional development. Can anyone tell me what is it used for? What is CPD used for? Vakas is absolutely right. Muna is absolutely right. Suleiman is right. The idea that directors have up-to-date knowledge. Talha, they can give potential benefits to each other, but remember, they're all independent of each other as well. So why would they? Since they're all independent, why would they? Maintaining and updating skills. Absolutely, you are all correct. So CPD is maintaining and updating skills. The chairman ensures that the board has requisite skills, the required skills to actually take effective decisions. So, how does the chairman ensure that the board is effective? By regular meetings, by having an agenda and minutes, by having sufficient information for decision making, by leading the appraisal process in order to ensure that performance is evaluated of the board of directors on timely basis and on a regular basis. And he also ensures that a regular CPD is conducted in order to ensure that skills of board of directors are kept up to date. That is CPD, and those are the responsibilities of the chairman of the board. We are over here, the roles of a non-executive chairman. This is what we are doing. And right now we are going to be doing the roles of a chief executive officer. So someone was asking what slide we were at. This is here. Updating your knowledge. That's perfect. All right. So within the board, the chairman of the board is responsible for shareholders and the board's effectiveness. What does the CEO do? Let's see what the CEO does. All right. So what the CEO does is he bridges the communication gap between the board and top level management of company. So look at a map over here. Shareholders communicate with the chairman, who communicates with the board of directors. And in the board of directors, there are executive directors and non-executive directors. And within those executive directors, there's the CEO, who communicates with the top level management or department heads within an organization. So both the CEO and the chairman bridge communication gap. However, the chairman bridges communication gap between the board and the shareholders, while the CEO bridges communication gap between the top level management and the board of directors, and vice versa. Both are responsible for bridging communication gaps, but with different parties. Chairman will bridge the communication gap between shareholders and the board of directors, and the CEO will bridge the communication gap between top level management of company and the board of directors. So any requirement of department heads from the board of directors will be communicated to the board of directors by the CEO of the company. Now, the next responsibility of the CEO would be to implement strategies taken by the board. So the next responsibility of the CEO is to implement strategies decided by the board in the company. Implement strategies decided by the board within the organization. So what the board does is it decides on a strategy. For example, the board has just decided that over 5 years, a new project is to be initiated in Pakistan. What the CEO will then do is start implementing this 5-year plan within the organization. How? How is the CEO going to do it? By managing resources, by ensuring that there are finances, human resources, and other administrative resources available to implement these strategies. He also manages risks and controls in organization. So remember, while the chairman of the board is primarily concerned with the board and the shareholders, the CEO of the company is primarily concerned with the top level management of the company and the operations within an organization. Remember, two different people, two different responsibilities. The chairman is a non-executive, while the CEO is an executive. The chairman runs the board, while the CEO runs the organization. The chairman is primarily bridging the communication gap between shareholders, while the CEO is bridging the communication gap between the top level management and the board of directors. The chairman is going to decide on strategies along with the board, while the CEO is going to be implementing those strategies within an organization. Why does corporate governance require a segregation of roles? To avoid concentration of power in one person's hands. So what would happen if one person is the CEO and the chairman of the board? Can anyone tell me what would happen if one person is the CEO and chairman of the company? Can anyone answer the question? What would happen if one person is the CEO and chairman of the board? Absolutely. The answer is he will be able to dominate decision making. And in order to prevent domination of decision making, corporate governance says that chairman and CEO should be two different people, so that if one person is responsible for running the board and running the company, one person will have too much power in their hand and will be able to pass whatever decision that they want within an organization. All right, since we are out of time, we are going to be covering the slides that are left tomorrow. What you have to do for tomorrow is read question on the next slide. I'm going to be underlining the question that you have to do. Please bear in mind that we will start with this question tomorrow. June 2015, question number 1D1. If you open your practice handout, the Word document, I'm just going to scroll through. This is this question. Lysis, June 2015, question number 1D1. The question that you have to do is, hold on, let me deconstruct the requirement for you. All right. Discuss the potential benefits of an effective non-executive chairman could have brought to Lysis. This carries 8 marks. How many potential benefits do you have to discuss? Can anyone tell me how many potential benefits will you have to discuss? Then not 16, definitely not 8, 4. You have to discuss 4 potential benefits of a non-executive chairman for Lysis. That's it. 4. 1 point will carry 2 marks. So 1 point is equal to 2 marks. We will start from here. Please bear in mind that I will be forwarding a 100-page summary to you by the end of these sessions that is going to be covering all topics in detail. There might be some small miscellaneous topics that we might not be covering during these sessions, but bear in mind that I promise that there will be no important topic that I will be leaving out, and those topics that I do leave out will be covered by that 100-page summary that I'm going to be forwarding to you. It's not going to be probably 100, it's probably 110, I'm not really sure, but most definitely will be forwarded to you. Thank you very much. I'm going to be hearing from all of you tomorrow. Let's look forward to then. Bye-bye.